joint ventures in India have been both an opportunity and a challenge for cross-border investors. Studies indicate that globally, as many as 40 to 60% of joint ventures underperform or fail to meet their potential. India reflects a similar trend, with a significant number of joint ventures eventually being abandoned and several high-profile collaborations dissolving within just a few years of their inception. While the Indian market offers huge potential, these challenges mean that entering into a joint venture here requires far more than just signing a good agreement. Hello and welcome back to another episode of Veyrah Law's video series. In our last episode, we discussed some of the best cities and states in India to set up a business. Today, we're going one step further to talk about joint ventures in India, why they have been both an opportunity and a challenge for cross-border investors, and what lessons can be learned from the last 3 decades. My name is Ajay Joseph. I'm a partner at Veyrah Law. We are a law firm based in Mumbai, India. To know more about us, you can take a look at our website. The link is in the description below. As usual, before we get started, a quick reminder. These videos are not advertisements or solicitations. They are only for sharing knowledge. Nothing shared here should be treated as legal advice. Please consult your own advisors before making any decisions. Lastly, please read the disclaimers carefully. With that said, let's start into today's topic. Since India opened its markets in 1991, we have seen several waves of foreign investment. In the early years, most global companies entered India through collaborations with Indian partners. At that time, 100% foreign ownership was not permitted in many sectors, so joint ventures were the natural route. However, India's track record with international JVs has been mixed at best. Studies indicate that globally, as many as 40 to 60% of joint ventures underperform or fail to meet their potential, underscoring the inherent risks of such partnerships. India reflects a similar trend, with a significant number of joint ventures eventually being abandoned and several high-profile collaborations dissolving within just a few years of their inception. Common reasons include differences in management styles, cultural clashes, shifting regulations, and over time the easing of FDI restrictions that made some local partnerships redundant. As the saying goes, in business, partnerships are easy to make, but hard to maintain. With that said, let's talk about the key challenges that cross-border investors face when forming joint ventures in India. The first is misalignment of business objectives. Foreign partners often come in with long-term strategic goals focused on scale and efficiency. Indian partners, on the other hand, may have different priorities, such as cash flow or revenue, or focus more on market access and control. These differences often surface once the business starts operating. The second is cultural differences. Many Indian businesses, especially traditional family-run enterprises, operate on personal relationships and informal decision-making. In contrast, foreign investors from developed markets are used to more structured corporate systems, clear reporting lines, and performance-driven management. Then comes corporate governance. Global investors are generally bound by strict governance standards, transparency norms, and board independence. In India, governance practices can vary widely, especially in promoter-driven companies, leading to friction in day-to-day management and decision-making. There's also the difference in mindset. Contracts versus relationships. Foreign companies tend to rely heavily on detailed contracts to define rights and obligations. In India, business relationships often depend as much or more on trust and personal rapport than on what's written in the contract. This contrast can cause serious misunderstandings when problems arise. Finally, enforceability is a big concern. India's judicial system is overburdened with more than 50 million cases pending, and contract enforcement can take many years. This means even the most airtight contracts may not offer quick relief in cases of disputes. So while the Indian market offers huge potential, these challenges mean that entering into a joint venture here requires far more than just signing a good agreement. It demands patience, due diligence, and a deep understanding of how business is really done on the ground. When it comes to joint ventures in India, most of the international best practices for successful partnerships still apply. However, there are a few India-specific considerations that every foreign investor should keep in mind. First, partner diligence. While India has many reliable business houses, there are also some less scrupulous players who can give the rest a bad name. Always conduct detailed background checks before signing or legally committing to anything. Second, realistic expectations. India is a price-sensitive market. According to recent venture and market reports, including the Bloom India Outlook 2024, Indian consumers and businesses remain extremely value-driven. So pricing, positioning, and growth timelines must reflect that reality. Third, record broad terms early. Before moving to detailed documentation, partners should agree on key commercial principles: equity control, funding, exit, and dispute mechanisms at the outset. Fourthly, alignment on deal terms. Attention to contracts in India is often not as rigorous as in developed markets, partly due to weaker enforcement. Make sure both parties understand and truly agree to what's written. Don't assume the contract alone will govern behavior. Fifth, structure smartly. Consider routing the joint venture through an intermediary or holding entity, especially if multiple partners or foreign exchange issues are involved. Sixth, account for regulation. Depending on the sector, approvals and compliance can be complex. It often helps to outsource licensing and approvals to professional vendors familiar with local bureaucracy. Seventh, plan for separation. Just as some couples have prenuptial agreements, partners should have a clear exit or buyout mechanism to manage a breakup amicably if things don't work out. Eighth, financial visibility. Ensure the joint venture has transparent operations, bank accounts visible to both sides, an independent CFO reporting directly to the board, and clear audit rights. Ninth, governance and control. Secure rights to appoint directors and maintain effective board oversight. Where possible, foreign investors should retain majority ownership, perhaps through two group entities, so management changes can be implemented smoothly. 10th, be mindful of family dynamics. If partnering with a family-run business, ego clashes between promoters and professional managers are common. Have open discussions early about management roles, compensation, and decision-making authority. This, of course, is not an exhaustive list, but it highlights practical steps that can help mitigate the risk of failure and build a sustainable, well-balanced joint venture in India. To wrap up, let's take a step back. We've seen that India offers immense potential for joint ventures, but it's also a complex market that demands patience, preparation, and perspective. Since 1991, the country has come a long way, yet many of the structural challenges remain. The takeaway is simple. Papers and contracts can only help so much in India. The real skill lies in how you position yourself, both commercially and contractually, to protect your interests while building trust with your local partner. Success here isn't just about drafting the perfect agreement. It's about understanding the local context and aligning expectations. As someone rightly said, paper doesn't make partnerships, people do. We hope this episode has given you a clearer picture of how to navigate joint ventures in India, what to watch out for, what to plan for, and how to structure partnerships that actually work. If you found this video useful or know of others who may benefit from it, please do share it. It will help make India a safer destination for other investors. And as always, if you have questions or topics you would like us to cover, drop them in the comments below or send us an email. Someone from the team will surely get back. Thank you for watching and see you in the next episode.